Hello, how are we doing today? Welcome to Consensus Invest. I'm your first talk of the day. Thank you all for joining us so early and sharing your breakfast with me. We'll be talking a little bit about the history of crypto and finance today. One moment. Little help back there. Thank you. Okay, great. I'm your host, Peter Ryan. I'm a research analyst with CoinDesk, who is the host of today's conference. I received a BA in economics from New York University, and you can follow me on Twitter @_Peter Ryan. So to start us off, I want us to think about going into the past and figuring out what is Bitcoin. Pulled up a little dictionary definition for you. It's a digital currency created for use in peer-to-peer online transactions. So that's very general, that's very simple. The best way to think about it, it's a digital form of money, the same way you can use US dollars. Usually nowadays, digitally, you're not actually exchanging paper dollars too often. The same way you can use Bitcoin. You can use that to store your value, you can use it to exchange value if you're buying goods and services. And you might ask, where is Bitcoin located? Well, again, it's not exactly paper. It's in a network over the internet between different nodes around the world that are connecting into this simultaneous network that's going on constantly. And maybe one of the most important questions to understand about Bitcoin is, when did it come about? It came about right around the time of the financial collapse of 2008. We saw home prices going down, which led to an overall economic slowdown, and unemployment was up. We saw stocks going down, businesses getting closed, a big catastrophe. One of the remedies of that was that we almost doubled our money supply in that period. Around that time, Bitcoin came into being, with a lot of connotations suggesting that this is an alternative to the current system, which produced the negative consequences we just saw, and that we'll be able to have an economy that is potentially not able to inflate itself into nearly double in a very short period of time that can lead to all sorts of negative consequences like hyperinflation. And so that's where the white paper came in, and this is where the who of Bitcoin comes in. It's written by Satoshi Nakamoto, who is the anonymous founder of Bitcoin and the wider cryptocurrency industry. He wrote this white paper during that time, the financial collapse, as a technical way to explain what the network of Bitcoin was in sending transactions back and forth over this cryptographic network. And so how do you actually send transactions? How does this actually work? What happens is users, that's you, that are businesses, that are exchanges, all these different entities are having a private key, which is cryptographic. Same way you might use a username and a password, it's a similar type of form. You have your own key, which has a certain amount of Bitcoin allocated to it. You send that to various other private keys, through a process of signing transactions with your private key signatures, and you end up exchanging value that way. Now, what happens in between is that when you send and broadcast that transaction up to the network, there's a very specific entity called miners, or better yet, transaction validators, that are going in and they are looking at that transaction, they are validating that it is true, and they are adding it to their blockchain. Now, there's a bunch of miners out there competing to validate because there's a reward at the other end of that. That reward takes the shape of a certain allotment that is given out automatically by the system, and also transaction fees that are variable based on the miners' market incentives. And so the miners are incentivized through profit to validate these transactions and compete against one another. They do that by sending computing power to the system to figure out a certain problem that's going on in the network. And once they solve that problem, by throwing more and more computation power at it, known as hash rate, they're able to win the block, hence the blockchain, and put transactions in that block and put it on the blockchain. And this happens every 10 minutes or so. And miners will do this continuously, day after day. There are no holidays, there are no time off, there is no 9 to 5. This is happening globally, universally, and all the time. And so ultimately, what is the why of Bitcoin? What is the why of cryptocurrencies? Back then, the why of Bitcoin was that we were going to get individual financial sovereignty, where people can hold their own private keys. They don't have to trust third parties necessarily, like banks or other custodian-like businesses, that will hold their value for them and that they'll have to take on that risk. Now they can internalize that risk to themselves and have more control of their money. The next why of Bitcoin was that it's a collective, stable form of value. Similar to how we saw the US dollar's supply almost double in around 2008, this isn't exactly a feature of Bitcoin. In fact, the lack of this ability is the feature of Bitcoin. There's a certain fixed inflation rate that is occurring over Bitcoin the next 100 years, where it will reach a supply cap of 21 million. That 21 million and that fixed inflation rate gives users a feeling of comfort, a feeling of security, and a better way to predict the future. If you don't know what your money supply is going to be 5, 10, 30 years down the road, it makes it really hard to actually make business decisions and plan for the economy. So this becomes one of the two main investment theses of Bitcoin. But now, Bitcoin isn't the only thing that is out there. After Bitcoin was created, we saw a few years thereafter other cryptocurrencies starting to come online. And they started to present other novel theses to why they should be invested in and also why they should be utilized. And so we look at use cases like privacy. And we see a coin like Monero as an avatar of this. Right now, Bitcoin might be anonymous in a sense, but if people are able to pin you to your specific private key, then they're able to know transactions that are going to you and going from you. This is the nature of the public ledger, the public blockchain, where everyone's validating transactions in this open and global way. And so Monero and other cryptocurrencies like it came online in order to provide the use case of privacy, where they're shielding that information of where the transactions are being sent, how much money is being sent, giving users a feeling of privacy that we don't really see in Bitcoin too much. And then we have Ethereum, which is the avatar for smart contracts. And this is where the next level of what digital currencies can do, I think, really comes in, where you not only have the ability to exchange value, to store value, but you also have the ability to program that value. You can program special automatic transactions, contracts into certain business relationships. You can have certain disbursements based on an event taking place that happen all automatically on the blockchain. And then that brings us to maybe the more hot topic of the cryptocurrency world in the past year or so, which is the ICO. This is the initial coin offering. This takes the form of fundraising for a lot of startup businesses that might not have had the option of going to that route previously, and opens up a lot of liquidity to that early stage market. This is a very risky investing market to get into. I would say that if you're looking at the risk-reward curve, this is very much high on that. And so, but what this does, it enables people to rethink how you go about fundraising in early stage startups. How does equity get shared? What is the proper ratios between founders, investors, advisors, and the eventual power users of that platform that want to get in early? So you could say that this is combining the best of the Kickstarter-like process as well as the venture capital-like process in a new way that's still nascent and is still being figured out. And so that is really the past of Bitcoin, of other cryptocurrencies coming online, showing their other novel use cases. But let's talk about the present now. Right now, we're in a market that's in total about 123 billion. The total ICO funding that's taken place is 22 billion, which dwarfs the amount of VC funding that has gone into it at about just under 6 billion. And the number of cryptocurrencies we have is 2,071. Now that's pretty astonishing for a movement that came out of nowhere back in 2008. But the elephant in the room, or better yet, the bear in the room, is that we are in a bit of a bear market, and prices are down. There's been some volatility. Some negative woes are being circulated. But let's have some perspective here. We might be down 61% just this year, but we're also up in the 2-year, 420%, and if you go back 5 years, we're up 316%. I don't think I need to tell you the 10-year return. It's pretty big. It's pretty big. But now, we talked about the past, we talked about the present. Now let's talk about the future of Bitcoin and cryptocurrencies. We're looking at Wall Street, institutional investment classes, different derivative products or forms of cryptocurrencies that can come online. There'll be a lot of that discussion going on today from various speakers, which I'm sure you're all excited to hear. Some of you also might be in that pool. The other future that is there is retail. Will small, average consumers actually adopt cryptocurrencies when they go to the grocery store, start spending this in a way that is everyday, that is quick, easy, where they don't have to think about it. So this isn't to say that one or the other is going to take place. There could be a leaning towards one, a leaning towards other, depending on exactly how the timeline plays out. But ultimately, we'll see cryptocurrencies get adopted either or both as an institutional asset class where large institutions come in, they put value behind the cryptocurrencies, bring that market up, which enables a secure and less volatile system, which then enables retail to come in when it's safer and less volatile, so the average consumer might not lose 61% of their value in a year. But then asset classes and just the medium of exchange property is not the only future. There's the future for enterprise businesses and startups as well. Now this means more of the tech use cases, not so much as the monetary properties we talked about earlier. This is more of how do we share information back and forth in a way that's decentralized and that can be audited properly. We're seeing large businesses like IBM starting to adopt this in their supply chain planning, where we have a system that is open, transparent, and is able to be audited by multiple parties to secure that we know the objects, the products, the services that are getting through the system from point A to point B to the final consumer. But enterprise might not be the ultimate destination for cryptocurrencies. Startup businesses also have a very innovative structure to them to bring these different currencies in and use these as utility tokens, which is a nomenclature getting passed around now, where it's largely used in the ICO market, where users will invest, and instead of getting security, they're getting a utility token, which they'll be able to use within that cryptocurrency's network later down the road. This means that, think of it more as fuel rather than money or a piece of equity, where they exchange fuel that they put just in that one system in order to make that system run for them. Whether that can be a video game or some sort of prediction market, that's what's going on with a lot of these startups that are using the utility function of these cryptocurrencies to produce value. And so ultimately, while we can think about the institutional asset class, the individual consumer exchanging in retail, or large enterprises like IBM or small startups engaging in this type of behavior, the resounding ethos that's occurring right now, especially in this bear market, is that we're moving from a colloquial term known as HODL, which is a joke around the industry that means to hold, to save, to not bend when the market is dipping. And we're moving towards BIDL, which is obviously build, or build technology, make more innovation in this technology. And so what you'll ultimately see most likely in the future, whether it takes place in any of those four categories, is that a lot of entrepreneurs and technologists and financiers are looking to this technology in a way that is a little bit more thoughtful, a little bit more constructive, and that ultimately will build the pathway to a brighter future. Once again, thank you. My name is Peter Ryan. I'm a research analyst at CoinDesk. Please enjoy your time today, and you can follow me on Twitter @_Peter Ryan. Thank you.